I want to tell you about a man I met at a conference about 3 years ago. His name was Richard, and he had just turned 62. He had done everything right. He had saved diligently for 40 years. He had accumulated nearly $2 million in his retirement accounts. By any reasonable measure, he should have been set for life. But Richard was terrified. He pulled me aside during a coffee break and said something I will never forget. He said, "Bill, I cannot sleep at night. I have spent my entire adult life building this nest egg, and now I am supposed to spend it down. Every month I withdraw money, I watch the balance get smaller. What if I live to 95? What if there is another crash like 2008? What if inflation eats away at my purchasing power? I am paralyzed." Richard's fear is not irrational. It is the central anxiety of retirement. You spend decades accumulating wealth, and then suddenly you are supposed to reverse course and start depleting it. Every withdrawal feels like failure. Every market downturn feels like catastrophe. The psychological burden is enormous. But here is what I told Richard that day. There is another way. There is a portfolio strategy designed specifically for people over 55 that generates enough income to live on without ever touching the principal. A portfolio that actually grows over time even as you withdraw money every month. A portfolio that lets you sleep at night because you know it will never run out. Today, I am going to share that strategy with you. I am going to explain exactly how to construct a portfolio that can sustain you through a 30 or 40-year retirement. And I am going to show you the specific types of investments that make this possible. But first, let me explain why the conventional approach to retirement income is fundamentally flawed. Most financial advisors will tell you to follow the 4% rule. The idea is simple. You withdraw 4% of your portfolio in the first year of retirement, and then you adjust that amount for inflation each subsequent year. If you have $1 million, you withdraw $40,000 the first year. If inflation is 3%, you withdraw $41,200 the next year, and so on. The 4% rule was developed by a financial planner named William Bengen in 1994. He analyzed historical market returns and concluded that a portfolio of 50% stocks and 50% bonds could sustain 4% withdrawals for at least 30 years without running out of money. For decades, this rule has been gospel in the financial planning industry. Millions of retirees have based their entire financial lives on it. But here is the problem. The 4% rule was designed for a different era. It was based on historical bond yields that no longer exist. When Bengen did his analysis, you could buy treasury bonds yielding 6 or 7%. Today, even after rates have risen, you are lucky to get 4 or 5%. The 4% rule also assumes you are willing to deplete your principal. By design, it is supposed to leave you with nothing at the end of 30 years. If you live longer, you are in trouble. If you want to leave something to your children or charity, you are out of luck. And perhaps most importantly, the 4% rule does not account for the psychological reality of watching your nest egg shrink year after year. Even if the math works out, the emotional toll is enormous. What I am going to show you is a different approach. Instead of depleting principal, we are going to build a portfolio that generates enough income to live on while leaving the principal intact. Instead of hoping the math works out over 30 years, we are going to create a sustainable income stream that could last forever. The key insight is this. If your portfolio generates 5 or 6% in income, and you only need to withdraw 4 or 5% to live on, the principal never shrinks. In fact, it grows every year. You have more wealth, not less. The psychological burden disappears because you are not spending down your savings. You are living off the income your savings produce. Let me show you exactly how to build this portfolio. The foundation of the portfolio that never runs out is dividend growth stocks. These are shares of high-quality companies that pay regular dividends and increase those dividends year after year. Now, I know some people think dividends are old-fashioned. They think growth stocks are where the action is. They point to technology companies that pay no dividends and have generated enormous returns. But for someone over 55 who needs reliable income, dividend growth stocks are the ideal investment. Let me explain why. First, dividends provide income you can count on. When a company pays a dividend, that cash hits your account regardless of what the stock price does. Even if the market crashes 50%, the dividend checks keep coming. This stability is invaluable for retirees who need to pay bills every month. Second, dividend growth protects against inflation. Companies that regularly increase their dividends are effectively giving you a raise every year. If a company increases its dividend by 7% annually, your income doubles in about 10 years. That keeps pace with or exceeds inflation, preserving your purchasing power. Third, dividend growth stocks tend to be high-quality businesses. Companies cannot pay and grow dividends unless they generate consistent profits. The discipline of returning cash to shareholders forces management to focus on sustainable profitability rather than empire building. As a result, dividend growth stocks tend to be more stable and less risky than the broader market. Fourth, dividend growth provides total return. You are not sacrificing growth for income. Studies have shown that dividend growth stocks have actually outperformed the broader market over long periods. You get income plus appreciation. Let me give you some specific examples of what I mean by dividend growth stocks. Consider a company that makes consumer products used by billions of people every day. Products like toothpaste, soap, cleaning supplies. This company has paid dividends for over 100 years. It has increased its dividend for over 60 consecutive years. The current yield is around 3%, and the dividend has been growing at about 5% annually. If you invest $100,000 in this company, you receive about $3,000 in dividends the first year. But that $3,000 grows to nearly $5,000 in 10 years and over $8,000 in 20 years, assuming the dividend growth continues. Your income more than doubles without you doing anything. Or consider a company that owns some of the most valuable consumer brands in the world. Brands in beverages, snacks, and food that people consume every day. This company has increased its dividend for over 50 consecutive years. The yield is around 3% with dividend growth of about 7% annually. Or consider a company that provides essential healthcare products and pharmaceuticals. Products that people need regardless of economic conditions. Over 50 years of consecutive dividend increases. A yield of about 3% with solid growth. These companies are not exciting. They will not double overnight. But they are exactly what you want in a retirement portfolio. They are stable, predictable, and they pay you increasing amounts of cash year after year. Now, dividend growth stocks are the foundation of this portfolio. But they are not the only component to generate enough income. Without touching principal, we need to add some higher yielding investments. The second component of the portfolio is real estate investment trusts, commonly known as REITs. REITs are companies that own and operate real estate. Shopping centers, apartment buildings, office towers, warehouses, data centers, cell towers by law. REITs must distribute at least 90% of their taxable income to shareholders. This requirement means REITs typically offer much higher yields than regular stocks. The average REIT yields somewhere between 4 and 6%. Some specialized REITs yield even more. This higher yield accelerates your income generation and helps you reach the level where you can live on income alone. But not all REITs are created equal. For a retirement portfolio, I focus on REITs with certain characteristics. First, I want REITs with diversified, high-quality properties. I do not want concentration in a single building or a single market. I want hundreds or thousands of properties spread across the country. Second, I want REITs with strong tenant bases. I want tenants who pay their rent reliably through good times and bad. This means focusing on REITs with essential properties, things like grocery, anchored shopping centers, medical offices, industrial warehouses. Third, I want REITs with conservative balance sheets. Real estate is a leveraged business, and too much debt can be dangerous. I look for REITs with debt levels well below industry averages and strong interest coverage ratios. Fourth, I want REITs with track records of dividend growth. The best REITs do not just maintain their dividends, they grow them. This provides the same inflation protection as dividend growth stocks. There are several REITs that meet all of these criteria. REITs that own thousands of properties, have investment-grade credit ratings, and have increased their dividends for 20 or more consecutive years. These are the types of REITs I want in a retirement portfolio. The third component of the portfolio is bonds and fixed income investments. Now, I know bonds have been unpopular for years. When interest rates were near zero, bonds offered pathetic yields. Many investors abandoned fixed income entirely. But the world has changed. Interest rates have risen substantially. You can now buy high-quality corporate bonds yielding 5 to 6%. You can buy treasury bonds yielding over 4% for the first time. In nearly 2 decades, bonds offer meaningful income. For a retirement portfolio, bonds serve several purposes. First, they provide stable income. Bond interest payments are contractual obligations. Unless the issuer defaults, you will receive your interest payments on schedule. This stability complements the variable nature of stock dividends. Second, they provide diversification. Bonds typically move differently than stocks. When stocks crash, high-quality bonds often hold their value or even increase. This helps smooth out the volatility of the overall portfolio. Third, they provide capital preservation. If you hold a bond to maturity, you get your principal back regardless of what interest rates do in the meantime. This certainty is valuable for retirees who cannot afford to lose principal. For the bond portion of this portfolio, I focus on investment-grade corporate bonds with maturities of 5 to 10 years. I avoid junk bonds because the risk of default is too high for a retirement portfolio. I also avoid very long-term bonds because they are too sensitive to interest rate changes. I also include some Treasury inflation-protected securities known as TIPS. These bonds adjust their principal value based on inflation, providing explicit protection against rising prices. For retirees worried about inflation eroding their purchasing power, TIPS offer peace of mind. Now, let me put all of this together and show you what the complete portfolio looks like. For someone over 55 who wants a portfolio that never runs out, I recommend the following allocation: 50% in dividend growth stocks. This provides the growth engine of the portfolio. Over time, rising dividends will increase your income, and the appreciating stock prices will grow your principal. 25% in REITs. This provides the higher yield needed to generate sufficient income. The combination of current yield and dividend growth makes REITs an ideal complement to dividend growth stocks. 25% in bonds and fixed income. This provides stability, diversification, and capital preservation. The guaranteed interest payments add predictability to your income stream. With this allocation, the overall portfolio yield should be somewhere between 4 and 5%. If dividend growth and capital appreciation average 3 to 4% annually, your total return should be 7 to 9%. Now here is the magic. If your portfolio generates 5% income and you only withdraw 4%, the principal grows by 1% annually before considering capital appreciation. Add in capital appreciation and dividend growth, and your portfolio could grow by 3 to 5% per year even as you withdraw money to live on. After 10 years, a portfolio that started at $1 million could be worth $1.3 to $1.5 million, even after withdrawing $40,000 to $50,000 per year. After 20 years, it could be worth $1.7 to $2 million. The portfolio grows instead of shrinking. This is what I mean by a portfolio that never runs out. The income exceeds your needs, the growth exceeds your withdrawals, the principal expands over time instead of depleting. Let me walk through a specific example to make this concrete. Imagine you are 58 years old with $1 million saved. You plan to retire at 62 and need $50,000 per year to cover your expenses. Following this strategy, you invest $500,000 in a diversified portfolio of dividend growth stocks, yielding an average of 3% with dividend growth of 6% annually. You invest $250,000 in REITs, yielding an average of 5%, with dividend growth of 3% annually. You invest $250,000 in bonds, yielding an average of 5%. In year one, your income looks like this. The dividend growth stocks generate $15,000. The REITs generate $12,500. The bonds generate $12,500. Total income is $40,000. That is short of your $50,000 need, so you withdraw $10,000 from capital appreciation or principal. Not ideal, but manageable. But here is what happens over time. The dividend growth stocks increase their dividends by 6% annually. The REITs increase their dividends by 3% annually. After 5 years, your income has grown to approximately $52,000 per year. Now your income exceeds your needs. After 10 years, your income has grown to approximately $68,000 per year. You are now generating $18,000 more than you need. That surplus gets reinvested, accelerating your portfolio growth. After 20 years, your income has grown to approximately $95,000 per year. Your portfolio has grown to approximately $1.4 million despite withdrawing $50,000 every year adjusted for inflation. You started with $1 million, you withdrew over $1 million in cumulative income, and you still have $1.4 million left. The portfolio never ran out. In fact, it grew. This is the power of dividend growth combined with disciplined withdrawal strategy. It is not magic, it is mathematics, and it works. Let me address some common questions and concerns about this strategy. The first question people ask is what happens if the market crashes? This is a legitimate concern. We have seen multiple market crashes in recent decades, and we will certainly see more in the future. Here is the good news. Dividend growth stocks tend to fall less than the broader market during crashes. Companies that pay consistent dividends are typically more stable businesses with stronger balance sheets. When panic hits, investors flee to quality, which provides some support for these stocks. More importantly, the dividend payments themselves are far more stable than stock prices. During the 2008 financial crisis, the S&P 500 fell over 50%, but dividends only fell about 20%, and they recovered within a few years if you are living on dividend income rather than selling shares. A market crash is painful to watch, but does not necessarily disrupt your lifestyle. The key is to never sell during a panic. If your income covers your expenses, you can ride out any market decline. You do not have to sell low. You just keep collecting dividends and wait for the recovery. The second question is, what about inflation? This is perhaps the biggest long-term risk for retirees. If inflation runs at 4 or 5% annually, your purchasing power gets cut in half in 15 to 20 years. The portfolio I have described has multiple inflation defenses. First, the dividend growth stocks are increasing their dividends faster than historical inflation. Second, the REITs own real assets that tend to appreciate with inflation. Third, the TIPS portion of the bond allocation explicitly adjusts for inflation. No investment is perfectly inflation-proof, but this portfolio is far better positioned than a traditional bond-heavy retirement portfolio. The dividend growth alone should keep pace with or exceed moderate inflation. The third question is whether this strategy works with smaller portfolios. Not everyone has $1 million saved. What if you only have $500,000 or $300,000? The strategy still works, but you need to adjust your expectations. A $500,000 portfolio generating 5% yields $25,000 in annual income. That may not cover all your expenses, which means you might need to work part-time, delay retirement, reduce expenses, or accept some principal drawdown. The mathematics are the same regardless of portfolio size. The question is whether the income generated is sufficient for your needs. For smaller portfolios, Social Security becomes more important. A combination of this portfolio strategy plus Social Security benefits can provide adequate income even with less savings. The fourth question is about taxes. Dividends and bond interest are taxable, which reduces your effective income. This is a real consideration, but there are strategies to minimize the impact. First, hold as much as possible in tax-advantaged accounts like IRAs and 401k plans. Dividends and interest inside these accounts are not taxed until withdrawal. Second, focus on qualified dividends, which are taxed at lower capital gains rates rather than ordinary income rates. Most dividends from U.S. corporations held for more than 60 days qualify for this favorable treatment. Third, consider municipal bonds for the fixed income portion if you are in a high tax bracket. Municipal bond interest is exempt from federal taxes and often state taxes as well. The yields are lower, but the after-tax returns can be competitive. Fourth, be strategic about which accounts you withdraw from. Withdraw from taxable accounts first to let tax-advantaged accounts continue compounding. Withdraw from Roth accounts last, since those withdrawals are completely tax-free. Tax planning is complex and depends on your individual situation. But with thoughtful planning, you can minimize the tax drag on this strategy. Let me talk about the psychological benefits of this approach, because I think they are just as important as the financial benefits. When you have a portfolio that generates sufficient income without touching principal, your entire relationship with money changes. You stop watching the daily market fluctuations with anxiety. You stop calculating how many years your money will last. You stop feeling guilty every time you spend money on something you enjoy. Instead, you feel abundance. You have income flowing in every month. You have a growing asset base that will support you indefinitely. You have the security of knowing that your financial future is stable, regardless of what the market does tomorrow. This psychological shift is transformative. I have seen retirees go from anxious and fearful to confident and generous. When you are not worried about running out of money, you can actually enjoy your retirement. You can travel. You can help your children and grandchildren. You can give to causes you care about. Richard, the man I mentioned at the beginning, implemented this strategy after our conversation. I spoke with him about a year later. He told me he was sleeping through the night for the first time in years. He had stopped obsessing over market movements. He was finally enjoying the retirement he had worked so hard to achieve. That is what this strategy offers. Not just financial security, but peace of mind. Let me share some specific implementation advice for putting this strategy into action. If you are currently over 55 and want to transition to this approach, do not try to restructure your entire portfolio overnight. Gradual transitions are better for both tax reasons and risk management. Start by analyzing your current portfolio. How much dividend income does it currently generate? What is the yield? What is the dividend growth rate? You might be surprised to find you are already partway there. Next, identify holdings that do not fit the strategy. Growth stocks that pay no dividends, speculative investments, holdings you have been meaning to sell anyway. Consider selling these positions gradually and redeploying into dividend growth stocks, REITs, and bonds. As you build the new portfolio, reinvest all dividends and interest until you actually retire. This accelerates your income growth and portfolio growth. Every dividend reinvested is buying more shares that will pay more dividends in the future. When you do retire and start withdrawing, have a system for managing the cash flow. Most brokerages can automatically deposit dividends and interest into a money market fund. Set up automatic transfers to your checking account for monthly living expenses. Keep 3 to 6 months of expenses in cash as a buffer against timing mismatches. Review your portfolio annually. Make sure the allocation is still appropriate. Check that your holdings are still growing their dividends. Trim positions that have become too large and add to positions that have become too small. And most importantly, stay disciplined. There will be times when growth stocks are soaring and dividend stocks are lagging. There will be times when some hot investment seems irresistible. Ignore the noise. Stick with the strategy. The consistency of this approach is what makes it work over decades. I want to address one more topic before closing, and that is the role of Social Security in this strategy. For most Americans, Social Security provides a significant portion of retirement income. The average benefit is around $20,000 per year, and the maximum benefit for someone who earned high wages and delayed claiming is over $50,000 per year. Social Security has several characteristics that complement the portfolio strategy I have described. First, it provides guaranteed income for life. No matter how long you live, the checks keep coming. This eliminates longevity risk, the risk of outliving your savings. Second, it is adjusted for inflation. Social Security benefits increase annually based on the Consumer Price Index. This provides explicit inflation protection that supplements the implicit protection from dividend growth. Third, it is extremely low risk. Short of the complete collapse of the U.S. government, Social Security benefits will be paid. This certainty anchors your retirement income for most retirees. I recommend delaying Social Security benefits as long as possible, ideally until age 70. Benefits increase by approximately 8% for every year you delay past full retirement age. That is an incredible guaranteed return that is very difficult to match elsewhere. While you delay Social Security, draw more heavily from your portfolio. Once Social Security kicks in at the higher amount, you can reduce portfolio withdrawals and let the portfolio grow faster. The combination of maximized Social Security benefits plus the portfolio strategy I have described creates a nearly bulletproof retirement income plan. You have guaranteed inflation, adjusted income from Social Security plus growing dividend income from your portfolio together. They provide more income than most retirees need, with the surplus fueling continued portfolio growth. Let me bring this all together with a final thought about what this strategy really means. For most of human history, retirement did not exist. People worked until they could not work anymore, and then they depended on family for support. But they did that ordinary people could stop working and live off savings for decades is a remarkably recent development. This gift of retirement is precious. After decades of work, you deserve to enjoy life without financial anxiety. You deserve to pursue interests you never had time for. You deserve to spend time with family and friends. You deserve peace of mind. The portfolio that never runs out is designed to give you that peace of mind. Not just adequate income, but growing income. Not just survival, but prosperity. Not just getting by, but thriving. If you are over 55, you still have time to implement this strategy. Every year you save and invest in this approach brings you closer to a retirement where money is no longer a source of stress, where you can make decisions based on what you want to do rather than what you can afford to do, where you can be generous because you have more than enough. That is the retirement you deserve, and this strategy can help you achieve it. The mathematics work. The investments are sound. The psychology is transformative. All you need is the discipline to implement it and the patience to let it work over time. Start today. Analyze your current portfolio. Begin the transition toward dividend growth stocks, REITs, and bonds. Reinvest everything until you retire. And when you do retire, enjoy the income stream that will sustain you for the rest of your life. This is how you build a portfolio that never runs out. This is how you achieve true financial security. And this is how you earn the peaceful, prosperous retirement you have worked so hard to deserve. Let me spend some more time on the specific types of dividend growth stocks that belong in this portfolio, because selection matters enormously. When I evaluate dividend growth stocks for a retirement portfolio, I look for what I call dividend aristocrats and dividend kings. These are companies that have increased their dividends for at least 25 consecutive years in the case of aristocrats, and 50 consecutive years in the case of kings. Think about what it takes to increase dividends for 50 years. The company has to navigate recessions, financial crises, technological disruption, competitive threats, and management changes. Only truly exceptional businesses can accomplish this. The track record itself is proof of durability. There are only about 50 dividend kings in existence. Companies that make household products you use every day. Companies that provide essential services like electricity and water. Companies that manufacture medical devices and pharmaceuticals. Companies that sell food and beverages consumed by billions. These companies are not glamorous. You will never see them featured on the cover of business magazines as the next big thing. They are boring. But boring is exactly what you want in retirement. Boring means predictable. Predictable means reliable income. I also want to discuss the importance of diversification within the dividend growth portion of the portfolio. Do not put all your dividend growth allocation into one or two stocks. No matter how wonderful they seem, unexpected things happen. Companies that seem invincible can stumble. Management can make mistakes. Industries can be disrupted. I recommend owning at least 15 to 20 individual dividend growth stocks across multiple sectors. Consumer staples, healthcare, utilities, industrials, financials, technology companies that have established dividend programs. This diversification ensures that no single company's problems can derail your retirement income. You can achieve this diversification through individual stock selection if you enjoy research and have the time. Or you can use dividend-focused exchange-traded funds that hold dozens or hundreds of dividend growth stocks. The funds charge small fees, but they provide instant diversification and professional management. Either approach works. The key is broad exposure to high-quality dividend growers, rather than concentration in a few names. Let me also elaborate on the REIT portion of the portfolio, and why I believe real estate is such an important component. Real estate has several characteristics that make it ideal for retirement portfolios. First, real estate generates income from a completely different source than stocks and bonds. Stock dividends come from corporate profits. Bond interest comes from lending. Real estate income comes from rents. These income streams are driven by different economic factors, which provides genuine diversification. Second, real estate is a physical asset that tends to maintain value during inflationary periods. When prices rise, generally rents and property values tend to rise as well. This provides a natural hedge against the inflation that erodes purchasing power. Third, real estate income is relatively stable. Tenants sign leases for years at a time, even during recessions. Most tenants continue paying rent because they need somewhere to live or operate their businesses. This stability is valuable for retirees who depend on consistent income. Fourth, the REIT structure is tax efficient for income investors. Because REITs pass through most of their income to shareholders, they avoid corporate-level taxation. The full earning power of the properties flows to investors rather than being diminished by corporate taxes. Within the REIT universe, I favor certain property types over others for retirement portfolios. Residential REITs that own apartment buildings benefit from the essential nature of housing. People always need somewhere to live. During recessions, occupancy might decline slightly, but people do not stop living in apartments. Healthcare REITs that own medical offices, senior housing, and skilled nursing facilities benefit from demographic trends. The aging population needs more healthcare services, and those services need to be delivered somewhere. Industrial REITs that own warehouses and distribution centers benefit from the growth of e-commerce. Every package ordered online needs to be stored and shipped from somewhere. This structural tailwind supports rental growth for years to come. Net lease REITs that own single-tenant retail properties with long-term leases provide especially predictable income. The tenant is responsible for all property expenses, and the leases often extend 15 to 20 years with built-in rent escalators. I would avoid or underweight office REITs, which face structural headwinds from remote work, and regional mall REITs, which face structural headwinds from e-commerce. Some of these REITs offer tempting high yields, but the risk of dividend cuts is elevated. Let me also spend more time on the bond portion of the portfolio and how to think about fixed income in today's environment. After years of near-zero interest rates, bonds finally offer meaningful income again. This is a significant change for retirement planning. For much of the past 15 years, bonds were dead weight in portfolios, providing neither income nor growth. Now they serve their traditional role of generating income and providing stability. For the bond allocation, I recommend a ladder structure. Instead of buying all bonds with the same maturity, buy bonds maturing at different times. Some maturing in 2 years, some in 4 years, some in 6 years, some in 8 years, and some in 10 years. This ladder provides several benefits as shorter bonds mature. You can reinvest at prevailing rates if rates have risen. You benefit from the higher yields. If rates have fallen, you still have longer bonds locked in at the old rates. The ladder smooths out interest rate risk. For individual bond selection, focus on investment-grade corporate bonds from financially strong companies. Look for bonds rated A or better by the major rating agencies. Yes, you can get higher yields from lower-rated bonds, but the default risk is not worth it for retirement portfolios. I also recommend allocating a portion of the bond allocation to Treasury inflation-protected securities, or TIPS. These bonds adjust their principal value based on the Consumer Price Index. If inflation runs higher than expected, your TIPS will be worth more. This explicit inflation protection complements the implicit protection from dividend growth. A reasonable split within the bond allocation might be 70% investment-grade corporate bonds and 30% tips. This provides both current income and inflation protection. Now, let me address the question of how to actually generate income from this portfolio on a practical basis. Most dividend growth stocks pay dividends quarterly. Most REITs pay dividends monthly or quarterly. Most bonds pay interest semi-annually. This means income arrives throughout the year rather than in one lump sum for retirement planning purposes. I recommend setting up a system to aggregate this income and convert it to monthly cash flow. The simplest approach is to have all dividends and interest deposited into a money market fund within your brokerage account. This fund pays modest interest while you hold cash. Then set up automatic monthly transfers from the money market fund to your checking account for living expenses. This creates a buffer between income received and expenses paid. You do not have to worry about timing mismatches where you need money before a dividend arrives. The money market fund serves as a shock absorber. I recommend keeping at least 3 months of living expenses in this buffer at all times. 6 months is even better. This cushion ensures you never have to sell investments at inopportune times to cover unexpected expenses. Let me also discuss the importance of annual review and rebalancing. Over time, some investments will perform better than others. Stocks might appreciate faster than bonds. Some REITs might grow faster than others. Without intervention, your carefully designed allocation will drift from the targets. Once per year, review your portfolio and rebalance back to target allocations. If stocks have grown to 60% of your portfolio instead of 50%, sell some stocks and buy bonds or REITs. If REITs have declined to 20%, instead of 25%, sell some of the over-allocated assets and buy more REITs. This rebalancing serves two purposes. First, it maintains your risk profile. If you let stocks grow without limit, your portfolio becomes more aggressive than intended, exposing you to more volatility than you can comfortably handle. Second, rebalancing provides a disciplined way to buy low and sell high. You are automatically selling the assets that have risen the most and buying the assets that have lagged. This contrarian behavior tends to improve returns over time. Rebalancing is emotionally difficult because it requires selling winners and buying laggards, but it is one of the few free lunches in investing. The discipline of regular rebalancing can add 0.5% or more to your annual returns, with no additional risk. I want to share a few more stories about people who have implemented this strategy successfully. A woman named Margaret retired at 63 with $800,000 saved. Everyone told her it was not enough, that she would run out of money, that she needed to keep working. Instead, she implemented this strategy. She put $400,000 in dividend growth stocks, $200,000 in REITs, and $200,000 in bonds. Her first-year income was about $36,000. Combined with Social Security of $22,000, she had $58,000 to live on. That was 10 years ago. Today, her dividend and REIT income has grown to nearly $55,000 per year. Her Social Security has increased with cost of living adjustments. Her total income is now over $80,000. Her portfolio has grown to over $1 million despite withdrawing income for a decade. Margaret told me she laughs now when she thinks about how worried she was. She has more money than when she retired. She has more income than when she retired. And she has the peace of mind that comes from knowing it will continue indefinitely. Another example is a couple named James and Patricia who retired with $1.2 million. They were very conservative investors, terrified of losing money. Before learning this strategy, they had most of their savings in low-yielding CDs and money market funds. They transitioned gradually to the portfolio I have described. It took them about 2 years to complete the transition because they were nervous about the stock market. But once fully invested, they were amazed at the income generated. Their portfolio now generates about $60,000 per year in dividends, REIT distributions, and bond interest, combined with 2 Social Security checks totaling $45,000. They have $105,000 in annual income. Their expenses are only about $70,000. The surplus of $35,000 gets reinvested, further accelerating their portfolio growth. They estimate they will leave over $2 million to their children and grandchildren. money that will keep compounding and supporting the family for generations. These stories illustrate what is possible with the right strategy. The mathematics work, the investments are sound, the outcomes are predictable. All that is required is the discipline to implement and maintain the approach. Let me close with some final thoughts about what this strategy represents. Building a portfolio that never runs out is not just about money. It is about freedom. Freedom from worry, freedom from anxiety, freedom from the constant calculation of whether you can afford things you want to do. When you have confidence that your income will continue indefinitely, you can make decisions based on what enriches your life rather than what you can afford. You can take that trip, you can help that grandchild, you can support that cause. You can say yes to experiences instead of constantly saying no. This freedom is what retirement is supposed to be. Not a period of scarcity and constraint, but a period of abundance and possibility. Not a slow decline towards zero, but a continued journey of growth and fulfillment. The portfolio that never runs out makes this vision possible. It takes the financial anxiety out of retirement and replaces it with confidence. It takes the fear of running out and replaces it with the assurance of perpetual income. You have worked hard for decades to accumulate savings. Now it is time to put those savings to work in a way that supports you for the rest of your life. Not by spending down your nest egg, but by harvesting the income it produces. Not by watching your wealth shrink, but by watching it grow. This is the retirement you deserve, and this strategy can help you achieve it. Start today. The sooner you begin, the more time you have to build the income stream that will sustain you forever.